Welcome to VeriScope News. This channel is built on verification, clarity, and context. No speculation, no hype. Only what the data shows and why it matters. Each report here follows a consistent standard: primary sources, clear timelines, measured language. Our goal is not speed, it is understanding. Today's analysis focuses on U.S. inflation, specifically the December Consumer Price Report. It is a data-driven update that clarifies where prices stand, why recent readings shifted, and how policymakers are likely to respond. Inflation affects households, businesses, and markets. It influences borrowing costs, wages, and long-term planning. Small changes in monthly data can carry large implications over time. In this report, we will outline the numbers, explain the distortions that shaped earlier readings, and place the latest results into historical context. This is VeriScope News. Verified news, clear context. Inflation has moved from a short-term shock to a long-running adjustment. Over the past several years, price stability has become a central concern for consumers and policymakers alike. What began as supply disruptions and rapid demand shifts has evolved into a more complex environment. Monthly inflation data now carries added weight. Small variations can affect interest rate expectations, financial markets, and household behavior. At the same time, headline numbers can mask temporary effects that later unwind. December's report arrives after a period of unusual data conditions. A prolonged government shutdown disrupted price collection in the fall. This forced statisticians to rely on estimation methods rather than full surveys. As a result, inflation appeared softer than underlying conditions suggested. When those distortions fade, inflation readings can appear to rise suddenly. That does not necessarily indicate a new surge in prices. It often reflects a return to normal measurement. Understanding this distinction matters. Policymakers adjust rates based on trends, not single data points. Households plan budgets based on sustained price movements, not monthly noise. December's figures therefore serve as a recalibration point. They show where inflation stands once temporary factors are removed. They also help explain why expectations for near-term interest rate changes remain stable. This report examines what changed, what stayed the same, and how the latest data fits into the broader inflation story. In December, U.S. consumer prices rose 0.3% from the prior month. This increase matched the consensus forecast among economists. It followed a softer reading in November that was influenced by data collection issues. Over the 12 months through December, the Consumer Price Index increased 2.7%, unchanged from November. This indicates that inflation remains above the Federal Reserve's long-term target, but well below recent peaks. Excluding food and energy, so-called core CPI rose 0.2% in December. On a year-over-year basis, core inflation advanced 2.6%, also matching November's pace. These figures suggest gradual cooling rather than acceleration. Earlier inflation data had been affected by a 43-day government shutdown. During that period, the Bureau of Labor Statistics was unable to collect full price data for October. To complete the November report, officials used a carry-forward imputation method. This method assumed prices were unchanged from the previous month, especially for rents. In addition, November prices were collected later in the month. That timing coincided with holiday discounts. The combination of imputation and seasonal pricing artificially lowered reported inflation. As those effects unwound in December, prices appeared to rise. In reality, much of the increase reflected a normalization of measurement. The inflation pickup occurred alongside other economic signals. The unemployment rate declined in December. Job growth continued, though at a modest pace. Against this backdrop, the Federal Reserve is expected to hold its benchmark interest rate between 3.50% and 3.75% at its January meeting. Officials continue to monitor inflation closely, particularly through the Personal Consumption Expenditures Price Index, which serves as their primary gauge. To understand December's report, it helps to look at longer-term trends. Over the past decade, U.S. inflation has averaged close to 2%. That period included years of subdued price growth and low interest rates. The pandemic period marked a sharp departure. Supply disruptions, fiscal stimulus, and shifts in consumer demand pushed inflation to multi-decade highs. In response, the Federal Reserve raised rates aggressively. As supply conditions improved and demand normalized, inflation began to ease. By late last year, monthly increases slowed and year-over-year figures declined. However, progress has not been linear. Services inflation, particularly housing and rents, has remained persistent. Goods inflation has fluctuated, influenced by trade policies and input costs. Energy prices have added volatility. The shutdown-related data distortions complicate interpretation. Imputation methods are standard practice during data gaps. They preserve continuity, but can temporarily suppress or exaggerate movements. December's report effectively resets the baseline. It shows inflation once full data collection resumed. From a historical perspective, a 2.7% annual CPI represents moderation, not stability. The Federal Reserve's 2% target is designed to balance growth and purchasing power. At current levels, inflation still erodes real incomes, but at a slower pace than before. Labor market conditions also matter. Low unemployment can support wage growth, which helps households absorb higher prices. At the same time, sustained wage gains can reinforce inflation if productivity doesn't keep pace. This interplay between prices, wages, and policy defines the current phase. It's less about crisis response and more about fine-tuning. Household finances. For households, steady inflation around the mid-2% range has mixed effects. Price increases are slower than in prior years, but cumulative costs remain high. Rent, insurance, and essential services continue to take a larger share of income. Budget adjustments are ongoing. Households are prioritizing necessities. Discretionary spending remains sensitive to price changes. Prices. Goods prices reflect multiple forces. Import costs have risen in some categories. Domestic supply conditions have improved in others. The result is uneven price movement across sectors. Services inflation remains the key driver. Housing costs, including rents and owners' equivalent rent, adjust slowly. This creates persistence even when other prices stabilize. Jobs and labor. The labor market remains resilient. Unemployment has edged lower. Job growth is positive but slower. Wage growth has moderated. That reduces pressure on businesses to raise prices aggressively. It also limits rapid gains in purchasing power. Savings and investment. Higher interest rates have changed savings behavior. Households earn more on deposits than in previous years. At the same time, borrowing costs remain elevated. Mortgage rates continue to constrain housing activity. Business investment decisions factor in financing costs. These dynamics reinforce the case for steady policy rather than rapid shifts. Businesses. For businesses, price stability supports planning. Volatile inflation complicates inventory management and pricing strategies. A predictable environment allows for gradual adjustments. Input costs remain a concern. Energy, transportation, and labor all influence margins. Companies are cautious about passing costs fully to consumers. Overall, the December inflation data suggests an economy adjusting rather than overheating. The balance between demand, supply, and policy remains delicate. Analysts are focused on upcoming inflation releases. Monthly CPI and PCE reports will indicate whether December's increase was a one-time normalization. Labor market data remains critical. Wage growth trends will influence services inflation. Participation rates will shape supply conditions. The Federal Reserve's communications will also matter. Officials are expected to emphasize data dependence. Rate decisions will reflect cumulative evidence, not isolated readings. For viewers, the key takeaway is stability. Inflation is not accelerating rapidly. It is also not yet at target. Household planning should assume gradual change. Prices may continue to rise, but at a slower pace. Interest rates are likely to remain steady in the near term. Long-term decisions benefit from patience. Short-term volatility is part of the adjustment process. Understanding the data helps reduce uncertainty. A useful concept here is data normalization. When measurements are disrupted, temporary estimates fill gaps. Once normal collection resumes, reported figures adjust. This does not change reality, it changes visibility. December's inflation rise reflects clearer measurement. Normalization helps align reported data with actual conditions. Recognizing this process prevents misinterpretation. That concludes today's analysis. Measured data, clear context. Thank you for watching VeriScope News. We will continue to track inflation with accuracy and restraint.